Hi guys, Stanley here. I'm the co-founder of ValueInvestAsia.com, an investment portal where we'll give you investment news and in-depth analysis on listed company every single week. So if you're new to this channel, remember to hit that subscribe button so you'll not miss out on any of our videos. Today, let's talk about stock split. Among all the many catalysts captivating Wall Street, stock split might seems to be the one that has risen in popularity over the years. However, what exactly is a share split? The easiest explanation is that if we view the value of a company as a whole, like a pizza, share split is essentially cutting out more slices from that same pizza. The number of slices might increase, but the size of the pizza is still the same. So a stock split allows company to break each existing shares into multiple new shares without affecting its overall market value. Most recently, companies like Shopify has decided to join in other large tech companies like Amazon, Alphabet, and Tesla in announcing stock split. In Shopify's case, the share of the e-commerce software company will undergo a 10-for-1 split. On top of that, a founder's share for the co-founder and CEO Toby Luk will also be proposed. Companies may decide to split their stock for good reason, like lowering its share price to make it more affordable for retail investors. However, a stock split by itself doesn't change the company fundamental value. So if you're looking into such stock, it is always better to just focus on the business rather than whether the company is deciding on any corporate action like stock split. With that in mind, let's look through a few companies that have just done share split but might still turn out to be good long-term investment. Number 1, Shopify. Shopify is on a 100 years mission to make commerce better for everyone. And since its IPO in 2015, its share price has gone up roughly 2,000%. And that's despite the recent 60% sell-off from their all-time high. So this is a very rewarding journey for early investors. Shopify software help entrepreneurs, small businesses, and also retail brands to manage their sales online and also offline. Its services include everything from website management to social media management, marketing, and also digital payment. Shopify's focus over the next few years will be looking to scale up its fulfillment network. This means building up local warehouses from which Shopify's users can manage their inventory and quickly ship orders to customers. In an era of fast fulfillment and competition from other e-commerce platforms, Shopify needs to ease the challenge of doing business for small merchants. So if they can offer a simple and easy to use shipping option, it could be highly profitable if successful. And for a company that is still expecting double-digit growth for the next few years, Shopify stocks appear to be quite cheap at the moment at just 27 times its earning. But you should also note that Shopify will be spending roughly about $1 billion to build up its fulfillment network over the next few years. This is a huge capex for the company and might impact earnings over the near term. Nevertheless, the company has really proven its worth in the retail space, and it also has a mission that really benefits its strong user base as well. So with or without the share split, Shopify might be looking quite attractive at the moment. Next, the company is the alpha in this group, Alphabet. In July last year, Alphabet has undergone a 20-for-1 share split. The last time the internet search giant went through such activity is 2014. And since then, Alphabet shares has risen about 350%. There are plenty of reasons to believe that Alphabet will do well in the future. For one, digital ads is still growing and gaining more market share in the overall advertising space. And as digital ad grows, the main beneficiary in this space is still Google. Alphabet is then using this profit to fund its other projects. Google Cloud is one of these key success stories from the funding. Organizations are migrating their IT workload to data centers and adopting cloud-based services. So Google Cloud really provides another strong engine of growth for the company. Other great growth potential for Google includes Google Payment, YouTube, and other subscription services. And of course, not to mention its self-driving cars as well. Plus, Alphabet has one of the best balance sheets in the industry. It has roughly $140 billion in cash and investment. This makes its valuation look quite attractive. It is only trading at about 23 times its trailing earnings and 26 times its free cash flow. And when we look at its historical data, Google stock is certainly offering great value right now. Up next, we have to talk about Tesla as well. Tesla has a 5-for-1 stock split over the summer back in 2020, and its share price has doubled in value since then. In the recent SEC filing, the company has indicated that it is proposing another stock split. Yet, the long-term thesis for Tesla has remained the same. The consumer migration from internal combustion engine to electrical vehicles is still ongoing. And in 2021, about 67 million vehicles are sold worldwide. Out of that, only 6.5 million are electric vehicles. And from the electric vehicles, Tesla delivered close to 1 million vehicles that year. So as legacy automakers and other EV startups try to fire up the assembly lines to fight off Tesla, Tesla now still has a good chance of commanding the major slice of the EV market space. In fact, management believe that it can continue to grow its sales roughly in line with the EV industry. And that is about 50% a year. So for the next few years, we have here an automotive giant that is already dominating the EV space with an ambitious growth rate for the future as well. And there are a few other catalysts that can help Tesla supercharge its way to 100 billion in sales and beyond. For one, it has 2 new gigafactories in Berlin and in Austin, Texas. And although its gigafactory in Shanghai is facing temporary shutdown, that should just be a temporary issue. And of course, more importantly, there are also more factories planned on the way. But when we look at its valuation, it is trading at roughly 200 times its earning. So investors must be still quite optimistic with the company. But if you feel that EV industry will still continue to grow at a rapid rate, then Tesla might be one that you need to monitor. And of course, we come to the last stock of today, Amazon. Even though Amazon is now synonymous with e-commerce, it is not the key reason for its success. Instead, the company's success has been lying in its ability to allocate capital to better and more profitable projects time and time again. For example, Amazon Web Services, its cloud computing segment, generated only about 12% of revenue last year, but AWS commands about 60% of its overall operating profit. So Amazon is not really an e-commerce company, it is really an infrastructure company providing the backbone of the internet. And to maintain the level of moat, Amazon spent an incredible 66 billion in capital expenditure to support its long-term growth last year. With infrastructure costs only increasing thanks to inflation, and the pace of spending does not look to be slowing anytime soon. In fact, its 66 million capex is 20 billion more than in 2020. So you can see that this company is not slowing down in its reinvestment as it grows bigger. As for its valuation, its share price now is trading roughly about 49 times its earnings. However, if you believe that Amazon will continue to invest in the right project for its future, then there might be still a lot of legroom left for this mega company. That's all for today. Which one is your favorite company among our list? Share your view with us below. And if you have gotten value from our video, please give us a like and share it with a friend who you might think will benefit from it as well. And if you're ready to take the next step in investing, you can always check out our free investing course at valueinvestasia.com/free course. As always, my name is Stanley. Till we meet again, invest safely.